right now we're talking about our robo-advisors, passive investors. I kind of mentioned this in the intro. I think like the pitch was definitely, and you can go and look at, like I said, Internet Archive and see what the websites used to say. It used to be all about easy access to low-cost index fund portfolios. Because at the time, like in 2015, and we had Dan Bortolani on an episode recently talking about exactly this, that back then, building a portfolio of index funds was not easy. It's gotten so much easier over time. But in 2015 and even earlier, like in 2010 kind of thing, it was not easy to just, oh yeah, I'm going to get a portfolio of index funds or a portfolio of ETFs. That was a hard thing to do. Robo-advisors made it easy. And that was kind of the whole pitch. But Mark, you had a post on Twitter looking at dispersion in Canadian robo-advisor returns. So it was 5-year data. The best return over that period was 8.48% annualized, and the worst was 4.7% annualized. Now that's like, for a service that's kind of supposed to be, passive investing, we'll make it easy for you. Why is there a 4% spread in returns for an aggressive portfolio?
Yeah. And it was actually quite surprising to me. The reason I stumbled upon this is I'm writing, as we've talked about, I'm kind of Canadianizing a book for our friend Dan Solon. And there's a chapter in there on fees and robo-advisors and that type of thing. So I was looking up the returns and fees of various robo-advisors, and there was just a Money Sense article that just kind of broke it all down for me already. I was like, oh, this is perfect. I don't need to actually go and do the research. They've already done it. But I was quite stunned, as you point out, Ben, like the dispersion in those in the bottom and the top, and the rest of them were kind of like middle of the pack. But like, yeah, the best performing robo-advisor over 5 years was almost 8.5%. And from my understanding, that's the purest sort of index fund style robo-advisor that's out there. And then at the bottom, you had 4.7% annualized over 5 years, and like that's a significant difference. Like investing $100,000 over that time frame is the difference between pretty much $125,000 and $150,000 at the end of the period, right? And I think, to your point, robos came out as an easy way to get a global market cap index fund portfolio, and they've had to deviate from that. And I think, and you're going to talk about this, I know, but I think the big ETF providers like BMO and Vanguard and iShares coming in and just solving this problem with a single ETF, probably, and I'm totally speculating here, the robos probably looked at that one like, okay, well now we need to do something else. Like we need to go and do something for the fees we're charging, because they can just go and buy this for 20 basis points instead. And so maybe, I'm just guessing, but maybe that's why some of them started deviating from that original kind of pitch of this is an easy way to buy a market cap portfolio.
But part of the original pitch was also the use of technology, the whole user experience. So it wasn't just indexing. That may have been the investment value prop. But from a totality standpoint, a lot of it was the user experience, the mobile phone-based app, the slick interface, slick onboarding. That was a big part of it too, which just an ETF provider, even though they might have a one-decision portfolio, they can't offer the rest of that experience.
Yeah, that's true.
And they've made massive investments, like Wealthsimple. I can only imagine the quantum of their investment in the technology for the client experience.
It's really good. I don't know if you guys have ever opened a Wealthsimple account, but I opened one for my son just to kind of teach him about markets and volatility. And I did it all from my phone in like 10 minutes. And I was like, oh boy, like this is super, super slick, right? Not the managed robo-advisor portfolio. Like we basically bought XEQT, which is a global equity ETF, but the user experience is very, very impressive.
Right. And we've heard that from people saying they're more focused on that part of the value proposition as opposed to maybe they assumed it was the simple index value proposition on the investment side. Therefore, in their mind, that may be equal everywhere. Therefore, I'll go with the one that's got the better UX.
You're talking about the users?
Yeah.
Mm-hmm.
Yeah. Well, I think that's happened to a lot of people, but I also think that people have noticed that, in particular, Wealthsimple's returns have been like not great. I mean, in that list of robo-advisor returns, Mark, the lowest one, and I don't mean to pick on Wealthsimple, but as anyone that listens to the podcast regularly knows, they've come up a few times for various reasons. So I've just got a bunch of stuff that I've done on them in the past. But anyway, in this 5-year period that you had data on, or that Money Sense had data on, Wealthsimple had the lowest 5-year return. So we'll talk a little bit about why that is. But I think more generally, there are two main reasons that there is this dispersion. And actually, you even have data, Mark, on the 5-year returns of XBAL and VBAL. Mm-hmm. Even they have 40 basis points of annualized tracking error over that period. And those are, that's as passive as it gets. But VBEL has global bonds. XBEL has Canadian and US bonds only, and that's caused some difference. XBEL has more in a little bit more in US, a little bit less in Canada, like less home country bias, and the US has done so well over that period. So anyway, two relatively passive portfolios, relatively comparable portfolios. Even they can have pretty significant tracking error or tracking difference. And I think it's the same with the robo-advisors. So if you look at what's actually in their portfolios, one big difference is going to be just asset allocation.
Yep.
You think about like home country bias, or even just how much is in international versus US, other asset classes like REITs, and how they're allocating to that, if at all, how the stock bond mix changes. Like I looked at a couple different ones, and one of them had like the most aggressive portfolio still had 6% in bonds. So that can drive a lot of that tracking difference. And as we saw with XBEL and VBEL, very similar portfolios, but those little differences in asset allocation can make a big difference, even over a 5-year period. I looked at the BMO Smart portfolio. That's the one or Smartfolio. That's one where the most aggressive option had still 5% in bonds. And then they had 19% in Canadian stocks, 34% in US stocks, 35 international, 7 in emerging markets. And then Modern Advisor, a different robo-advisor, their most aggressive portfolio is 29% in Canadian stocks, 19% in US, 21% international, 20 in emerging markets, and 11 in Canadian REITs. Those are two, like, you sign up for these two different robo-advisors. Huge. It's huge. It's crazy.
Yeah. And we should probably also just point out before we go on that the returns that I posted and the returns we were talking about were for what we'd call a balanced portfolio. And if you look at the footnotes of that Money Sense article, they said all of the comparisons they did had between 50 to 60% in equity and I guess 40 to 50% in fixed income. So the returns that we're talking about for those particular robo-advisors, and I know you're going to get into more data, but the stuff that I was talking about at least is for what we'd call a balanced portfolio. So when you're comparing to like VBEL and XBEL, that's why you're making those comparisons, right?
Yep. Okay, no, that's a good clarification, because I will talk about different asset allocation profiles for Wealthsimple specifically, just because I had the data on those ready to go. Okay, so that's one piece. Asset allocation is going to be different, and is that good or bad? It's neither, but investors need to be aware that when they pick a robo-advisor, they are implicitly picking an asset allocation approach. And the robo-advisors will tend to have different ones. And it's not like you're just getting a good passive portfolio because you're using a robo-advisor. If you want 10% of your portfolio in REITs, personally, I wouldn't. But if you do, then hey, there's a robo-advisor that's doing that. If you don't want that, then you should pick a different robo-advisor.
Right.
But it's not like you can just pick a robo-advisor and automatically get a good portfolio. Although both of those are still relatively low-cost ETF portfolios, which is great, I guess. Maybe better than a bank actively managed mutual fund, but maybe not. And I actually have data on that too that I'll touch on in a bit. So that's one piece, asset allocation. I think that the bigger issue, in particular for Wealthsimple, and again, I'm sorry to pick on them, but it's just what I have data for, ready to go, is that they're engaging in something closer to traditional active management on some level. I'm not saying that Wealthsimple's selecting securities and doing fundamental analysis. They're not, but they have made changes to their portfolios in response to changes in the market environment in an attempt to improve their long-term returns. So again, I'm going to talk about Wealthsimple and how they've changed their portfolios over time. And they've been very good about detailing their changes and explaining exactly why they're doing them. They've been super open about it, so it's not like they're doing anything shady at all. But it is interesting to see they've made all these changes and the outcomes have not been great. That doesn't mean they've been bad decisions, and I do want to talk about that. So in 2019, the big change, they added longer duration government bonds and inflation-linked bonds, and they reduced their credit risk in their fixed income portfolio. They also added low volatility stocks, and they increased their exposure to international developed and emerging markets. And then in Q3 2020, they removed shorter term government bonds and replaced them with a mix of credit, longer term bonds, and gold. And then in March of 2022, they switched up the minimum volatility equity ETF for a different ETF that incorporates other factors like quality and momentum They changed their fixed income allocations back to what they were prior to the 2020 change, and they reduced their exposure to emerging markets. Lots of changes. I don't know if I captured all of them. Those are just the ones I was able to dig up.
Yeah, and those are pretty big changes, right? Like this isn't the difference between like picking one stock or the other. Like those are fundamentally different ways to think about portfolio allocation.
Yeah, they made meaningful changes. One other thing that's
tough to be a robot.
Yeah, tough to be a robot, for sure. And it's humans making the decisions. And I've talked to the humans that have made the decisions, and I'll touch on that a little bit too. Now, it is worth noting also that their current portfolios, so like when you go on their website now and you look at the historical performance of their portfolios that they show inception dates of 2016. Those portfolios are also materially different from the initial portfolios when the firm first launched. So they were managing portfolios as early as 2015, I believe. And you can find in archived web pages the holdings of those initial portfolios. And they used to be very different. Like they contained actively managed funds for dividend stocks, for risk managed stocks and risk managed bonds, in addition to having low cost index funds.
Do you know what that means? Risk managed stocks and risk managed bonds?
I don't remember. I read it. I read the pages for the funds.
Sounds good.
When I wrote this, but I wrote it months ago, so I don't remember what it. Yeah, it does sound.
Do you think all active portfolios are risk managed? I just wondered if it was a marketing term, if there's some like actual academic term that I didn't know about called risk managed stocks.
No, I'm pretty sure it's a marketing term. I'm sure they're doing something to manage risk, but I don't know what it is.
Does that imply there's risk unmanaged funds?
Maybe.
I think it implicitly does. Yeah, mean exactly that. Okay, so big changes from 2015 to now, but then there have been other changes since 2016 in the overall approach to portfolios. And so the question is, has this been good? Has it helped their performance? And of course, if it has, then that's great. They do post their returns, which is also very nice and transparent. They post the returns net of a 0.5% fee, which is the fee that they would charge on an account under $100,000. Then their fee is 0.4% if you're above. And they do have lower fee tiers for larger accounts too. So the numbers that I will talk about are net of a 0.5% fee. And it is worth mentioning that Wealthsimple's customers may be getting something other than portfolio returns for that 0.5% fee, just as PWL's clients do, although they're different services. But Wealthsimple customers might get convenience, peace of mind, and if it's a large enough client to access financial planning services, then they may also be getting that. I think I don't know what asset level you can access. Do you know, Mark, when you can get financial planning?
I want to say 500,000, but I also might just be pulling that number out of thin air. And I think
is their generation level is 500,000, so that might be right.
That could be. I can see if I can look it up while we're chatting here. I think it's also worth pointing out that from what I've heard, that if you think about a firm of that size and the number of staff they have, the number of clients, I think and this isn't a knock on them at all, but the quality of financial planning service is going to materially differ from other firms, right? So what is being called financial planning, from what I've read from reviews, is often just a basic retirement projection in some cases, or like an hour a year to discuss like goals and then kind of plotting goals. So the depth of financial planning, I think, is also worth noting at least. Yep,
I agree with all that. So just to set this up, people listening, keep in mind that the returns we're going to talk about are net of that 0.5% fee, which may be paying for stuff that is valuable to people for reasons separate from portfolio returns. So we're going to look at the since inceptions in 2016 return numbers through the end of 2023 for Wealthsimple and compare them to asset allocation ETFs from iShares as benchmarks. Now, the iShares asset allocation ETFs did not exist over this full period. So for periods when they didn't exist, I've backfilled with back-tested data net of the appropriate fees for the ETF, which will give us numbers that are very, very similar to what that ETF would have earned if it did exist at the time. but it is worth noting that it did not actually exist for this full period. Now, and the other thing I want to say is that these asset allocation ETFs are not like perfect benchmarks for Wealthsimple's strategy, because Wealthsimple is doing different stuff as we've mentioned. But my idea here is that this is a reasonable alternative that someone investing in Wealthsimple could have alternatively invested in to get the market's returns, because it's a nice, easy, single ticket portfolio. Okay, so they post returns for conservative, balanced, and growth portfolios, and those roughly map to 35%, 60%, and 80% equity portfolios. The conservative portfolio returned 2.5% annualized since inception in 2016. The iShares Core Conservative Balanced ETF portfolio, if it had existed over the full period, would have returned 4.6%. The Wealthsimple's balanced portfolio, 4.4% since 2016 through 2023. The iShares Core Balanced ETF portfolio, if it existed for the full period, it didn't, 6.14%. And then the growth portfolio for Wealthsimple, 6.5% annualized since 2016. And the iShares Core Growth ETF portfolio, 7.65%. So, I mean, big negative differences, even if we add back Wealthsimple's 0.5% fee. Even if we said that someone got a ton of value from that, so we're going to add it back to the returns.
Ben, did you do any sort of like attribution analysis? Like, can you point to a specific portfolio change that made most of that difference in the returns, or was it just a combination of things? Like, I'm just curious if it was like one kind of in hindsight poor outcome, or if it was a combination of other factors. Because it seemed to me just from reading out what you just said that the more conservative portfolios had a lot worse relative performance than the more aggressive ones. So it sounds like maybe that fixed income call in like 2020 or whatever it was might have been the big impact call.
Yeah, I think it was the fixed income call, and I did talk to Wealthsimple about this, and they showed me some data on, I think it was that fixed income trade where it was just like the trade made sense, but they just got a really bad outcome, and it really hurt. So yeah, I think you're right that it was the fixed income that really was a drag on stuff. Yeah, and then it's also worth mentioning that the 2015 portfolios, which was their first full year managing portfolios, I think they might have been open in 2014, and the first full year was 2015. Maybe that's what it was. So the growth portfolio in that first full year returned 4.7%, and the benchmark, the iShares benchmark, the iShares Core Growth ETF portfolio, 9.32%. And for balanced Wealthsimple, 1.65, iShares 7.69, and conservative Wealthsimple 0.71% versus 6.04 for the iShares comparable ETF portfolio. Keeping in mind that was, a different era basically, where that's when they still had a lot of the active stuff in there. It was a very, very different setup.
And sorry, that's just 1 year too, right? Like
that's just the 2015, yeah. Calendar year 2015.
And you're not accounting for any sort of tax drag that might have happened from those dispositions and switching, correct?
That's a good point. Yeah, no. And I don't know how they would have handled that. I'm sure they would have been tax aware when they transitioned to the new models, but I don't know the details there. So I sent my notes on this to Wealthsimple, to some people that I know there a while ago. I was going to make a video on it, and I still will. I got busy with other stuff. But then Mark, you suggested this, the Robo-Advisor topic, and I was like, oh, I actually have something written on this. We can use that. So I sent everything we just talked about. I sent it to Wealthsimple and ended up having a conversation with their CIO, who was great. He was previously at Bridgewater with Ray Dalio. He's brilliant. Like, talking to him was an absolute pleasure. And all of his explanations for the changes they've made to portfolios, you could easily argue that they're sensible, given the objectives that Wealthsimple has, which is minimizing the left tail of the distribution of outcomes for their customers, which is a perfectly reasonable objective. And like any investment decision, a good decision, which they may well have made, does not guarantee a good outcome.
Yep.
And even if you're going to get a good outcome in the long run, short-term noise, in the few years after you make a decision can make you look completely crazy, even if you've made an objectively good decision. Although I don't think that there are many objectively good decisions in investing. Anyway, so the big thing for investors to understand is that Wealthsimple, but robo-advisors in general are not necessarily buy and hold passive in quotes, investors. You can ask Wealthsimple for an ETF portfolio. They told me this when I talked to them, and I asked if I could say this. And I said I could, which is kind of cool. But I guess if you call their customer service and say, I want a buy and hold index fund portfolio, apparently they'll do it, which is kind of cool.
Defeats the purpose, doesn't it? Like at the end of the day, you're paying sort of higher robo-advisor fees. And if you're going to pay those fees to just get a sort of, again, air quote, passive portfolio, you can just do so with one of the other ETF providers. So.
Yeah, but you have to do it, right? Someone's got to implement it.
Sure.
Someone's got to report on it. Someone's got to do the...
But you get more than that, though, right? Like you do get some level of advice from Wealthsimple. And I think that they are trying to build out their advice services, especially for larger accounts.
But even within maybe I'm wrong, but could you not just open like a Wealthsimple trading account?
I don't know if you get access to the financial planning services. That's a good question.
Mm-hmm.
I'm not sure.
I don't know.
I'm not sure. Anyway, someone who is using the Wealthsimple's managed portfolio service and is happy paying their fees for whatever reason could request a buy and hold index fund portfolio, and my understanding is that they would be willing to do it.
Cool.
But I don't think most of their customers would be aware of that. Another one on this topic of our robo-advisors, passive investors. A big change was Wealthfront. I don't know how big it was, but Wealthfront in 2022. Wealthfront's one of the big U.S. robo-advisors.
Yep.
They made this big announcement. And I don't know how big the announcement was. I thought it was big because I was like, wow, these guys are crazy. But they pulled value.
Shockwaves.
Yeah, they pulled value out of their factor tilted portfolios in 2022, and they're to quote from their statement, they said, "We'll no longer use the value factor in our service, as research suggests it is no longer as effective as it once was." Uh-oh. I can't help but laugh there. Now I don't know if there's ever consent. And they're talking about price to book specifically. I don't know if there was ever consensus that value stopped being effective. I think there were obviously people who did think that for a period of time and maybe still do. But since January 2022, value has been pretty great. So I don't know. Maybe this was another case of a good decision with a bad outcome. I'm not sure. But if I look at the value premium measured in USD, because that's where Wealthfront is, from January 2022 to April 2024, value premium, so value minus growth, in the US, 1% premium, EFI 6.7% premium, emerging markets 9.55% premium since January 2022 through April 2024. Yeah.
Sorry, does international include? Oh no, it's EFI. I guess you have Canada as well.
I didn't include Canada in there just because I don't think Wealthfront cares about Canada, but
fair enough.
I do know that the value premium over that period has been very positive for Canada too.
Yeah.
It might actually be the highest premium of all those markets over that period.
Yeah,
wow, really?
Yeah.
I may have that somewhere. No, I don't have it open. Now, I do also want to say that PWL is not purely passive either, like in the sense that we're not just holding market capitalization weighted index funds and doing nothing. We tilt towards small cap and value and profitability, and we're using dimensional funds, not index funds. So we're doing different stuff too. And in a lot of cases, it has underperformed just buying index funds because value has not done super well. Although it has done very well recently, just over the last 10 or so years, it has not done very well. But I think a big difference is that we're not making changes to portfolios much over time. Like I've been here for more than 10 years now, and we've been doing the exact same thing the whole time, other than maybe adding profitability, dimensional adding profitability, and more recently adding short-term reversals to the strategy. But it's like big changes, like we're going to overweight emerging markets, or we're going to, materially change how we do fixed income. those, although Dimensional has added some more credit to their fixed income portfolio since I've been here. So they're having little changes, but nothing big and nothing tactical, like nothing in response to what we think is going to happen or what Dimensional thinks is going to happen. It's like small updates incrementally based on pretty serious research, as we heard about from Wade Dye in a recent episode.
Even look as COVID rolled through and the markets roiled in March of 2020. I mean, if you were in a 60-40 or 70-30, that was consistent, even on those days where the market moved 10%.
Yeah.
And your 60-40 became 55-45. They're automatically rebalanced. I mean, you stuck to the rules, and that's where, to me, these kinds of asset allocation tools really show their value, because it's automatic. It just takes the subjectivity out of the advisor's hands.
Yep.
Because it would have been very easy during that period, and we all remember it. It would have been super easy just to go, let's just wait and see. We'll keep a lower equity position. We'll see how it looks. And you could have missed easily that charging snapback that happened, late spring, early summer of 2020.
Oh, it's so hard to do, like as a human. Like it's so easy to pick that out in hindsight, right? And say, well, I would have bought here, I would have sold here. Like it looks obvious if you just look at the chart. But as I call when you're at the hard right edge of that graph and things are down, like I was opening the markets and every day it was like 10% down. And everybody has a trigger point, right? Where it's like, okay, enough's enough. We're going to rip off the Band-Aid. And being able to kind of systematically take that decision out of your own hands, even as an advisor, as an investor, I think is, to your point, it can save you. It's like insurance against massive potential mistakes.
Right.
Yep. Yeah. So I did want to throw that out there, that I'm not trying to say that we're better than robo-advisors because we, are perfect market cap weighted index investors. That's not the point at all. But I think it really just highlights that investors have to understand what it is that they're investing in. As I say, we could have had the same conversation just now about asset allocation ETFs or about index funds more generally speaking. Like you can't just take index funds and assume that you've got a good portfolio, because you could have really bad index funds. And I'm not saying that robo-advisors is bad. I'm just saying that robo-advisors are going to have different portfolios, and they're not passive and they're not objectively good investments. So you got to know exactly what you're doing. But that whole idea that a truly passive portfolio exists I think it's just a flawed premise from the beginning. Every portfolio, including index fund portfolios, as we just saw, contain a whole bunch of active decisions. That was lesson number 18, I think, in our most important lessons in investing episode that we did. There's no such thing as a passive investment. There's the spectrum of passive and active, but nothing is truly passive. And because everything is active on some level, you've got to understand which active decisions you're making and why. And it's the same thing when you're delegating those decisions to, in this case, a robo-advisor. You've got to understand how they're managing the portfolio, how they're approaching asset allocation, how they're making decisions about changing asset allocation over time. Those are all really important. And so I think the answer to the question, are robo-advisors passive investors? I would say, well, nobody is. So no, they're not, but that's not necessarily a knock against them. I think it's just it highlights that even with robo-advisors and with index funds and with human financial advisors and all that stuff, but I think robo-advisors have this image of being passive. So you've really got to evaluate how they're approaching both asset allocation and changes to asset allocation over time.
I don't know that the average investor is going to understand that either, right? Like to your point earlier, as this kind of starting as an index fund portfolio or a cap weighted index fund portfolio, I don't think it's obvious to a lot of people who are signing up with a robo-advisor service what they're getting. And the questions that you mentioned they should ask are all obviously very important, but I feel like the amount of financial literacy it takes to understand that would be such that you wouldn't really want to potentially a robo-advisor in the first place, outside of some of those other benefits that you talked about earlier, Ben. Right? Like if you're at the point where you're able to kind of analyze their portfolio decisions as an investor, like you're probably better off just either putting the portfolio together yourself or buying one of those one fund solutions. So I think like a lot of the average investors who bought the robo experience thought they were getting that sort of broad-based market exposure, and they didn't. And had you picked, say, Wealthsimple versus somebody else, your outcome was, totally different as a result of it, right?
It's really interesting. You'd love to know the psychographics of the typical new client going into Wealthsimple, because I'm hearing that they're having tremendous success getting new clients of late, like in the billions, which is great for them. But what is that profile? What is that key value prop that they're coming to them for? Is it the user experience? Is it indexing? In air quotes, is it passive? Which, as you guys know, I find such a loaded term, and everybody has a very different definition of what passive really means.
So while we were chatting, I did look up the pricing and features for Wealthsimple, and from what I can gather, just on the pricing page, you get the same benefits regardless of whether you're with the robo side or the self-directed side.
Okay, nice.
Cool.
I don't see a delineation between the two in terms of the services that you can avail yourself of. It looks like it's just based on assets. So we were talking about financial planning earlier, and so if you have $100,000 in assets, you get check-ins with an advisor, which is kind of like the lighter planning that I was talking about. But interestingly, at the generation level, Ben, which you said is at 500,000, you do get what they're calling financial planning, and that could be saving strategies, investment education, tax planning, retirement planning, estate planning, and insurance analysis. So I'd be really curious, actually, if any of our listeners have gone through that financial planning experience at the generation level or not. I'd be very curious to see what they thought of it. But I think also, Cameron, to your point, like Wealthsimple does a ton of cool stuff. Like if you just look at all the features and benefits, and some things that are maybe just more marketing than other things, but things like stock lending, like people are going to want that. People are going to want to see if they can, quote unquote, juice their returns by participating in like stock lending programs. And they have 5% cash, 5% returns on their cash accounts, which act like a checking account. Like these are really cool things. So it doesn't surprise me that they're seeing a ton of success in that.
Did they bring back the VIP lounge, the airport lounge passes?
So at the generation level, it says you get 10 passes per year. We've partnered with Dragon Pass to offer you and your guests 10 airport lounge visits per year, available at over 1,300 locations worldwide. So you need to have $500,000 with them, but these are really cool little perks, right?